As we've demonstrated before, one of the unique and distinguishing features of the Zacks research system is the composite analytics. As a review, composites are any basket of equities, be it a broad benchmark like the S&P 500 or Russell 1000, sectors like the S&P Healthcare, styles like the Russell 1000 Value, or individual portfolios of your own. Zacks gives you the ability to utilize our library of dozens of Zacks and S&P Russell composites, or you can create your own. The software then generates complete bottom-up weighted average fundamentals for you to perform truly unique growth, value, and quality analysis on the composite and compare it to any other benchmark or such as another composite, as we're seeing here right now. In this demonstration, we will utilize these unique features of Zacks to evaluate the two major styles of global equities, growth versus value, and what we can expect over the next 12 to 18 months for these two distinct groups. Let's begin our analysis by invoking the two composites that track the Russell 1000 Value and Russell 1000 Growth, tickers RUS1VM for value and RUS1GM for growth. You can look up any of the Russell or S&P composite tickers by simply clicking on this magnifying glass just next to the ticker box. And in the resulting window, click the drop-down menu and select either the S&P or the Russell composite proxies. This menu will contain all of the relevant indexes, ranging from the broadest market index to the sector and style-specific components, to the even more specific sector memberships within those styles. We begin our analysis by comparing the total returns of value and growth stocks respectively. You can immediately note that over the entire period spanning from the late 1990s through just prior to the Great Recession and financial crisis of 2008, value stocks and growth stocks moved in tandem with one another. Post-2008 crisis is when the major separation in performance began, and since then, growth stocks have enjoyed tremendous returns, buoyed by a robust recovery in earnings and revenues, as we shall see in the coming charts. Thereafter, we can see that growth continues to dominate value in terms of performance over multiple time periods. So what is driving these excess returns? Value stocks, which by definition trade at lower premiums to their fundamentals and therefore have higher expected returns, should outperform growth over a total market cycle, but we haven't seen any evidence of that since the turn of the century. Does this mean value, at least as defined by the Russell 1000 Value style benchmark, and most actively managed portfolios benchmark to it, has lost its luster? Let's use the tools of Zacks Analytics to determine whether the Russell 1000 Value, as a composite, presents an attractive investment thesis relative to its counterpart, the Russell 1000 Growth. We can see immediately that value stocks suffered significantly more than growth in the aftermath of the Lehman crisis that triggered the freeze-up in credit in 2008. Whereas growth stocks felt a much lesser sting to their earnings, as we can see here. A similar story goes into play for both revenues as well as free cash flow growth. You can also quickly see how value has essentially stagnated since 2012 on top line and bottom line growth. Switching over to valuation, we know value stocks by definition trade at lower multiples, as you can see here, when compared to growth stocks or even the composite index. The Russell 1000 Value currently sits at a PE multiple of 15.84 compared to the 19 multiple for growth stocks. However, and more importantly, Zacks charting tools makes it easy to look at how deep that valuation discount is relative to the average discount over time. In other words, how does the current discount compare to the average discount historically? Simply click the R button on the charts toolbar, and the answer is revealed within seconds. You can see that the current discount is roughly 17%, as denoted by the ratio of the PE multiples at 0.83, whereas the median value over this entire 15-year period, interestingly enough, is also 0.83. If we look back even further, we can see that the discount remains right around that ballpark. This tells us that although value stocks have significantly lagged growth stocks in total returns, and despite the fact that value stocks trade at a discount to growth, we can see that the relative valuation still does not present a compelling investment thesis for value stocks. A similar analysis can be done on the price to sales multiple, and it shows the exact same results, with the ratio currently being very much in line with the median ratio over the past 15 years. ZRS charting also gives you the ability or the option of adding standard deviation bands to help put the analysis into context. And this is showing exactly what we just theorized, that the current valuation discount is right inside of the normal +1, -1 standard deviation range over the past 15 years. Similar charts for price to cash flow actually reveal a potentially elevated, though not unreasonably high valuation for value stocks, as we see here. However, interestingly enough, EV to EBITDA multiples might be the one area indicating a potential opportunity. Since we're using composites to represent a basket of stocks, different companies have different capital structures and therefore different equity valuations. EV to EBITDA partially accounts for this, since EV represents the total market value of all debt and equity, and EBITDA represents a cash flow to the firm for all of its stakeholders. From this perspective, relative EV to EBITDA for value stocks compared to growth stocks actually might be an interesting opportunity right now. We can see that the ratio of EV to EBITDA of value stocks compared to growth stocks is 0.62. Whereas the median value is a little bit higher at 0.69. This tells us that not only are value stocks trading at a steep discount to growth stocks, but it is trading at a discount greater than what it normally trades at, historically speaking. If we switch our focus just slightly to net debt to total capital, this chart reveals exactly why this is happening. Growth stocks have higher enterprise values and therefore higher EV to EBITDA multiples due to the fact that they've been ramping up leverage since 2012, as we see here. Value stocks, on the other hand, have been doing the exact opposite, which they've been delevering their balance sheets since the beginning or since the onset of the crisis in 2008. The winner here is clearly value stocks, as leverage risk has greatly declined over the past several years. Let's take a look at other potential factors that could influence future returns. You can see that returns on equity for value versus growth paints a dismal picture for value stocks. During the late 90s, growth generated excess ROE, but since the bursting of the tech bubble in early 2001, we saw value stocks generate higher return for shareholders. That trend has since reversed since the 2008 financial crisis, and now growth continues to generate significantly excess ROE. This leads us smoothly into the direct comparison of two related items, efficiency as measured by ROE, and value as measured by PE. A PE multiple compression accompanied by excess ROE growth would actually indicate a significant investment opportunity, but we see no evidence of that at all right now for value stocks. Relative PE multiples remain in line with historical averages, while at the same time, value stocks have been significantly lagging their growth peers in generating returns on equity. Now, price multiples are one way to look at the relative appeal of stocks. But what does the discounted cash flows approach tell us? Zacks is the only equity analytic platform that allows users to use composites, such as the Russell 1000 value that we're using here right now, or even your own portfolios, to our visual multi-factor interactive valuation model. You can access this model simply by clicking on the Valuation Model tab on the upper left-hand corner of Zacks. Our approach is the simplest one-stage dividend discount model approach to valuing stocks, except we utilize earnings as opposed to dividends. It begins by taking the consensus analyst long-term growth rate estimate, currently sitting at 8.37%, with one standard deviation subtracted out to correct for outliers and other analyst biases, which leads us to 5.32%. The result is a stream of linear, normalized earnings, which are now growing at a clip of 5.32%. You can see that although the model is based on a simple one-stage constant growth assumption, future earnings are likely to come in at the midpoint of the long-term economic cycle, as you can see was the case historically. This means that the model will underestimate earnings in boom periods and overestimate earnings in bust periods, giving you a true long-run intrinsic value estimation. So, taking our base assumption of 5.32% growth, we can immediately see that the Russell 1000 values lower price multiples, and despite the fact that value stocks have lagged growth stocks, we can still see that value stocks are roughly overvalued by about 2.6%. and represent only roughly a 5% upside over the next year. If we compare this to growth stocks, we can see a slightly different picture. We can see here that if we take the default starting point, growth stocks, on the other hand, are trading roughly in line with its intrinsic value, which represents an upside potential of about 9.8% over the next year. The Zacks valuation model is therefore an efficient tool for GARP managers who focus on looking at value as a function of fundamental growth. As such, we can actually see a confirmation here by looking at the PEG ratio. The PEG ratio confirms exactly what we just drew from the results of discounting future earnings, with value stocks coming in at 1.89 PEG multiple, and growth stocks registering a 1.56 PEG multiple. This represents quite a premium over historical averages, as we see here. The ratio of 1.21 compared to 0.98 over time. Switching our focus a little bit to the quality of growth. The growth and margin view is a concise table that summarizes annualized historical growth comparatively between top-line revenues and bottom-line profit, as well as directly compare any distortion created on a per-share basis. You can see quickly and analyze quickly this buyback effect on revenues and revenues per share, or earnings versus earnings per share. This table on the bottom left-hand side represents the annualized growth rates over various time periods for these four primary items. You can see here that although earnings per share has grown by somewhere between 3 to 5% historically on an annualized basis, revenues have only grown by somewhere between -2 and 1% over that same time frame. You can see that this disconnect is driven by share buybacks. As we see here on the column to the far right, shares outstanding have been systematically declining year over year, and that's projected to continue according to analyst forecasts. Let's take a look and let's pause here and take a look at this for 1 second. ZRS standardized financial templates provide a simplistic and easy-to-read glance at summary balance sheet, cash flow, and income statement line items. Here, the common size balance sheet reveals to us that value stocks are currently sitting on 24% cash relative to their total assets. If we compare that to growth stocks, we can see the divergence here fairly easily. where growth stocks are sitting at 17.5% cash to total assets. Now, this is probably intuitive because we know that growing companies tend to have higher capex and therefore a higher cash burn rate. But it points to the ability for value stocks to continue or even accelerate their share buyback programs. And so going back to that growth and margin page, we can take a look at what the projections are for the actual growth. So similarly to what we saw earlier with value stocks' faltering growth, we also do see here that analyst forecasts are fairly dismal at -7% revenue contraction and a 1% earnings per share growth. This disconnect between revenue and earnings per share growth seems to be driven not only by corporate share buybacks, but we can also see here of projections of improved net margin performance, picking up from 12.25% that we actually saw over the past 4 quarters, all the way up to 14.1%. If we use and look at our margin analysis chart, this is very interesting, as we can quickly see here on the bottom chart that net margins have actually never exceeded 12%. Yet analysts are now forecasting in excess of 14% net margin improvement. This does actually jive with what we're seeing here with operating margins and gross margins, as we see that both of these items are well off their all-time highs. So this represents one unique opportunity that exists for value stocks, is that there is opportunity for further cost cuts by reducing SG&A and other expenses, and thereby improving their operating margins, which would then help them achieve all-time high earning or net margins as what analysts are forecasting. This will give value stocks a relative padding or a cushion to help combat this abysmal revenue growth that we see here, clocking in at -4.8% over the past 12 months. Therefore, in summary, it seems as though value stocks have perhaps only 3 quivers only 3 arrows in their quiver. We know that, or what we saw here is that we know that value stocks have deleveraged their balance sheets. The net debt to total capital has been falling, while growth companies have been levering up. We know that cash represents 24.5% of total assets, compared to 17% for growth stocks. This presents an opportunity for share buybacks, dividend hikes, and potential M&A activity. And thirdly, we know that margins are improving. Analysts are projecting higher net margins, and there's also room for improvement in operating margins. However, the reasons to be bearish on value stocks is that relative valuations are in line with historical averages, representing very little opportunity. Value stocks are actually overvalued when using the DCF method. There's still abysmal growth. We know that there's total stagnation for free cash flow and earnings, and actually negative growth for revenues. And we also know that there's a lack of management value creation, where ROE, ROA, and ROIC are all subpar, with almost no evidence of recovery. So the evidence simply does not add up to value stocks representing an attractive valuation relative to growth stocks at this time. We can look for value stocks to outperform if we see a broader earnings recession, but for now the evidence is still overwhelmingly in favor of remaining tactically overweight on growth stocks. We hope you found this video to be helpful, and also the tools that we utilize in ZRS to be helpful. To discuss further or to perform a similar strategy session for any stock, sector, or style that you're currently evaluating, feel free to contact your Zacks account manager. We hope to continue to create value for your investment process and your workflow.